Securities Markets Foundation Part 2. Market Structure, Participants and Regulation. This part explains the foundational framework of the securities market, identifying the main players and the regulatory bodies that govern them. Dual structure of the securities market. The securities market has two interdependent and inseparable segments, the primary market and the secondary market. Primary market, new issue market. This is where issuers first raise capital by issuing securities to investors. It is responsible for creating financial assets. Secondary market, stock securities exchange. This facilitates trade in already issued securities among investors. Its primary role is to make securities marketable by transferring risk from one investor, seller, to another, buyer. Key market participants. The market relies on the interaction of four main groups: investors, issuers, intermediaries, and regulators. Investors and issuers. Issuers are organizations, like companies or governments, that raise money by issuing securities. Investors are individuals or organizations with surplus funds who purchase these securities to earn a return. Retail versus institutional investors. Retail investors are individuals investing personal funds, while institutional investors, e.g., mutual funds, banks, invest large sums and use specialized knowledge. Financial intermediaries. Intermediaries are agents who coordinate between investors, lenders, and issuers, borrowers, and organize the transfer of funds and securities. Without them, transactions would be difficult. Issue managers. Merchant bankers, or lead managers, structure the instrument, determine pricing, and manage the entire capital mobilization process for a new issue. They may also perform underwriting by committing to buy unsold portions of an issue. Trading facilitators. Stockbrokers are registered members who execute buy and sell transactions on the exchanges for investors. Authorized persons, APs, act as agents for brokers to reach more investors. Record keepers. Registrars and share transfer agents maintain the official records of investors for the issuer. Depository participants, DPs, help investors hold and transact in dematerialized, electronic, securities. Advisors and custodians. Asset management companies, AMCs, and portfolio managers manage investment portfolios for a fee. Custodians hold securities and funds on behalf of institutional investors. Securities market regulators. The responsibility for regulating the market is shared among multiple government bodies, but SEBI is the chief regulator. Securities and Exchange Board of India, SEBI. As the chief regulator, SEBI's main objective is to protect investor interests and facilitate market growth. It regulates stock exchanges, oversees primary and secondary market functions, and combats illicit activities like price manipulation and insider trading. Reserve Bank of India, RBI. The RBI regulates the money market, foreign exchange, and controls the government securities market. Its monetary policy decisions influence interest rates and borrowing costs. Other regulators. These include the Ministry of Corporate Affairs, MCA, regulating companies via the Companies Act, the Ministry of Finance, MoF, overseeing capital markets and banking insurance sectors, IRDAI, insurance, and PFDA, pension funds.